Welcome back. Okay, it is Fed time. A two-day policy meeting has kicked off in Washington today. Today and tomorrow, many are expecting a quarter-point rate cut. 100% expect a quarter-point rate cut. Joining us right now is Vining Sparks chief economist Craig Dismuke. And Craig, it is always a pleasure to see you. Thanks for being here.
Hey, good morning, Maria.
So we're having a conversation this morning about what a cut in interest rates is really going to do. We are all expecting that the Federal Reserve will announce tomorrow that they're cutting interest rates by 25 basis points. What's the impact from your standpoint? Is this all priced into the market?
I think it's largely priced into the market. I think there's two ways to look at this. Number one is from an economic standpoint, real economic activity. I don't think cutting rates 25 basis points, this would now be 50 basis points total in cuts, is really going to move the needle for business investment decisions, for consumer lending decisions or borrowing decisions, et cetera. What I think it does, though, is on the flip side, is that it reaffirms optimism for the markets. It gives the markets optimism that the Fed is going to come in and loosen conditions, ease conditions, financial conditions, when there's so much uncertainty out there. And I think that's key right now with all the uncertainty that's in the market, is that the Fed is responsive. And so that's where I think the impact comes from. And I think you've seen that play out in the markets already. The key is if they don't cut, I think the impact would be much worse.
Yeah, if they don't cut, well, I guess we'll see a sell-off in stocks, don't you think, Tegan? But they are going to cut. I mean, there's not even a reason to.
Right. It would be disruptive to myriad asset classes, potentially. But are you seeing signs, Craig, of the improvement in sentiment, if you will? And I'm not talking about consumer sentiment, but at least business optimism.
So you don't see, so business confidence was a little bit weaker last month. It has held in relatively well. The outlook for sales has stayed fairly strong. The overall economic outlook has dropped more than the outlook for sales has, which tells us that, yeah, real activity is continuing to be decent. The problem is that their overall view of the economy has been a little bit weaker. So I don't think that the Fed cutting is necessarily boosting business investment per se. I think more so it's boosting market confidence that the Fed is going to act. They're going to ease policy at a time when the markets are saying that they need to.
Craig, Bob Nardelli here. In normal times, you know, a quarter point, and then as you made, 50 points so far this year would have had an impact. But, the thing you just mentioned about the certainty of uncertainty, the external events, as I talk to a lot of my colleagues and they're sharing with me their biggest concerns, what are you hearing as the biggest concern out there that is maybe having some downward pressure?
Well, we work with a lot of financial institutions, and so the flatness of the yield curve, the potential for negative rates in the future has become a really big concern over the past 3 months. When we saw the 10-year drop 55 basis points in August alone, when we saw the Germans issue a 30-year zero coupon bond at a premium, those things started to get some of the financial institutions anxious. As it relates to industry, I think the biggest concern is just trade uncertainty and not knowing what will come in the future. The U.S. economy continues to be decent, held up by a very strong consumer, but it's that uncertainty about what's going to happen globally, what's going to happen with trade policy that we keep hearing.
Yeah, and where do you think this is going? I mean, a new Bank of America Merrill Lynch survey shows that recession fears are on the rise. 25% of U.S. credit investors say that they believe there will be a recession in the next year. Craig, we know that this economy has slowed down. Do you think this uncertainty around trade is the reason? And are you expecting a recession?
So we don't expect a recession in the short term if the Fed eases policy. I think one of the reasons that recession fears has risen is because the yield curve inverted 2 weeks ago and 3 weeks ago. That 2's10 spread inverted. And when everybody sees the headline that the yield curve is inverted, they get anxious. They start to think, well, it's always been accurate in the past with the exception of 98. Remember in 98 it inverted, except the Fed cut 50 basis points within 4 months. And so that's why I think it's so important that they do cut, because of all the fear that's being created by financial conditions, by the inverted yield curve. And so if they were to come in and cut, I think that eases that up a little bit. It reduces the risk of recession. But if you don't, and you were to let that inverted yield curve persist, it can start to affect credit creation and banks don't want to lend when their cost of funds are higher than the yields they can get on their loans. And businesses don't want to borrow because by the same reasoning, they think a recession might be coming because of the inverted yield curve.
Yeah. All right. We will leave it. It's sort of like a vicious cycle. Craig, it's good to have you. Thanks so much.
All right. Thank you, Maria.
Craig Dismuke joining us there.